Hey there, hope all is well. Just wanted to point out an interesting opportunity I found on Google today that I took a position on. So looking at the 1 year weekly chart, we can see that the top to bottom moves over the past 8 weeks, which would start on January 3rd or so this year, the average move was $7.88 approximately. The median move was $6.30 top to bottom. That means that the range for the week from the high to the low should be anywhere from $6.30 to $7.88, assuming we follow the same trend that we followed for the past 8 weeks. So today, we had a very, very narrow movement of about 84 cents top to bottom. And the reason why this is important is because if you look at the option chain and price out the straddle for this week, for this coming Friday, which is March the 3rd, the at the money calls and puts combined cost only $2.40. So if we get the expected move based on the past 8 weeks of movements, we should move somewhere to 95 on the upside or somewhere to 85 on the downside approximately. Why this is important is because if we price out the straddle, and I'll show you the option chain over here now, one sec. We price out the straddle and see that the cost right now for an at the money call and at the money put combined is about $2.40. So if we go back to the chart again and look at the cost of this trade versus the potential upside based on the average move over the past 8 weeks, this trade has about 100% upside, whereas the downside is pretty nominal because last Friday, just for reference, the straddle cost was about $1.50 on Friday itself, which tells us that if the premiums were to decay and Google were to stagnate around $90 all week, which is unlikely unless we break from this trend, then on Friday, the position would trade at $1.50, which would be down about 90 cents from the current entry price of $2.40. So again, some food for thought here, because the upside, assuming we push up to 95 or down to 85, would be $2.60 or more than that perhaps, which is a very, very nice asymmetry of risk on the trade, given that your downside would be about 90 cents in the event of stopping out at $1.50, assuming we stagnate around the current price by Friday. So again, you want to think about this trade from an asymmetry of risk standpoint, probability of profit standpoint. Your break-evens would be 90 plus 240 or minus 240. So 92.40 or 87.60. And obviously beyond that would be profit territory. Now, how to manage the trade? Well, if we move up on a given day to say 95 or down to 85, what one could do is they could sell whatever side is profitable, covering the entire position, and then hang on to the opposing side and hope for a reversal to profit off that side as well. Again, it's not likely that'll occur, but this is just an interesting way of thinking about trades by looking at patterns. So if you have any questions at all, drop them below. Again, everything here discussed is for educational purposes only. Manage your own risk, yada, yada. Hope you're doing well, and I'll see you guys next time.